On January 10, 2024, the SEC approved 11 Bitcoin spot ETFs simultaneously, a decision that had been denied for a decade. In the first 30 days of trading, these ETFs accumulated over $10 billion in net inflows, the fastest ETF launch in history. BlackRock's IBIT became the fastest ETF ever to reach $10 billion in assets. But futures-based Bitcoin ETFs had existed since October 2021, when ProShares Bito launched with $1 billion in first-day volume. 2+ years of living side by side, investors have now learned the hard lesson about the structural difference. Futures ETFs don't track Bitcoin's price, they track Bitcoin's futures curve, which includes a premium called contango that systematically erodes returns. Over the 2022 to 2024 period, Bito underperformed spot Bitcoin by over 20 percentage points due to roll costs alone. For institutional allocators, understanding this difference is not optional. It is basic product due diligence. A Bitcoin spot ETF holds actual Bitcoin in custody through a qualified custodian, just as a gold ETF holds physical gold. The ETF's NAV tracks Bitcoin's spot price directly, and authorized participants can create and redeem shares against the underlying Bitcoin, keeping the ETF price in line with NAV. A Bitcoin futures ETF holds Bitcoin futures contracts, financial derivatives that obligate the buyer to purchase Bitcoin at a specified price on a future date. Futures ETFs must continuously roll their positions as contracts expire, selling near-term contracts and buying further-dated ones. When longer-dated futures trade at a premium to near-term prices, a condition called contango, this rolling process sells cheap and buys expensive, creating a systematic return drag. When the futures curve is inverted, backwardation, futures ETFs actually benefit from rolling. But Bitcoin's futures curve has historically been in contango, creating persistent underperformance versus spot Bitcoin. The performance data comparing Bitcoin spot and futures ETFs is compelling for institutional decision-making. Since the launch of Bitcoin spot ETFs in January 2024 through Q1 2026, BlackRock IBIT has tracked Bitcoin's spot price with a tracking error of under 0.15% annualized. ProShares Bito, the largest Bitcoin futures ETF, underperformed Bitcoin spot by approximately 10 to 12% in 2022 and 8 to 10% in 2023 due to contango roll costs. The total expense ratio of IBIT is 0.25%, significantly lower than BITO's 0.95%. In net flow terms, the launch of spot ETFs transferred approximately $8 billion from futures-based products to spot products in the first 6 months, an institutional migration that reflected widespread recognition of the performance drag in futures-based structures. Total Bitcoin spot ETF AUM exceeded $60 billion by Q1 2026. For institutional allocators, the choice between spot and futures Bitcoin ETFs hinges on 2 dimensions: price exposure fidelity and operational context. Spot ETFs win on price exposure, they track Bitcoin directly, have lower fees, and don't carry contango drag. Futures ETFs have a niche institutional use case, for investors whose mandates restrict direct commodity ownership but permit futures-based commodity exposure. Futures ETFs provide Bitcoin access within existing investment policy statement language. This is particularly relevant for certain pension fund, insurance general account, and registered investment advisor mandates written before spot ETFs were available. The second futures ETF use case is tactical. Because futures settle in cash and don't require physical delivery, some institutional investors prefer futures ETF exposure for short-term tactical positioning where the contango cost over a few months is acceptable relative to the operational simplicity. Both ETF structures carry institutional risks that differ from direct Bitcoin ownership. Counterparty risk in spot ETF centers on the custodian. Coinbase Prime holds Bitcoin for BlackRock IBIT, Fidelity custodies FBTC itself. Institutional due diligence must include custodian financial health and insurance coverage assessment. Futures ETF risks include basis risk. The spread between futures price and spot can widen significantly during market stress, causing the ETF to deviate sharply from Bitcoin's actual price. Both structures share market hours risk. ETFs trade only during stock market hours, but Bitcoin trades 24/7. Significant Bitcoin price moves overnight or on weekends create pricing gaps when ETF markets open. For institutional investors who require continuous hedging or real-time position management, direct Bitcoin custody remains superior to either ETF structure. BlackRock's IBIT launch in January 2024 is the defining case study in institutional Bitcoin ETF adoption. BlackRock applied its proven ETF infrastructure, the same creation and redemption architecture used in IEMG, LQD, and other flagship products, to Bitcoin, with Coinbase Prime as custodian and a fee structure initially matching its equity ETF pricing. The product reached $10 billion in assets in 49 days, the fastest ETF to do so in history. By comparison, Gold ETF GLD took over 2 years to reach $10 billion. The speed of adoption reflected pent-up institutional demand that had been blocked for a decade by SEC denials. Within 90 days, IBIT had displaced Grayscale Bitcoin Trust as the world's largest Bitcoin fund. The case demonstrated that institutional Bitcoin demand was not primarily retail speculation. It was institutional allocation waiting for a compliant, familiar vehicle from a trusted asset manager. Institutions selecting a Bitcoin ETF structure should follow a 4-step decision framework. Step 1 is IPS language review. Confirm whether the investment policy statement permits direct commodity exposure, spot ETF, or only futures-based commodity exposure. If IPS language predates spot ETF availability, amendment may be required before spot ETF allocation. Step 2 is fee and tracking error comparison. Build a multi-year return simulation comparing total expense ratio and expected contango drag for futures ETFs versus tracking error for spot ETFs at the plan holding period. Step 3 is custodian due diligence. For spot ETFs, review the custodian's financial condition, insurance coverage, and segregation of assets architecture. Step 4 is liquidity and spread assessment. Evaluate bid-ask spreads and average daily volume for the target ETF, particularly important for large institutional block trades. 3 institutional mistakes define poor Bitcoin ETF selection. First, using a futures ETF for long-term strategic allocation without modeling contango drag. At 8 to 12% annual underperformance, a 3-year futures ETF position could underperform spot Bitcoin by 25 to 40% cumulatively. Second, assuming all spot ETFs are equivalent. Fee differences of 0.05 to 0.5% compound meaningfully over multi-year holding periods, and custodian concentration risk across providers is not identical. Third, forgetting that ETFs don't trade 24/7, institutions managing crypto exposure through ETFs lose the ability to respond to overnight or weekend news events, which is a meaningful operational constraint for active risk management. The spot ETF approval in January 2024 was the most important structural development in institutional Bitcoin access since Bitcoin itself was created. For institutions, the lesson is to evaluate ETF selection with the same rigor as any other fund product. Expense ratio, tracking error, custodian quality, and liquidity depth are all material variables that compound over holding periods. Futures ETFs had a place in institutional portfolios when spot was unavailable, but that use case is now narrow. The spot versus futures ETF distinction is not a technical footnote. It is the difference between tracking Bitcoin and systematically lagging it by double digits annually. Getting this right is fundamental product selection. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.